Cathie sounds alarm and says that if the Fed does not cut interest rates, then we will see more banks fall. We Tesla stock investors want to pay close attention to what the Fed does, because if Fed rates do go down, all of the growth stocks like Tesla are likely to explode again. US demand deposits, which make up the vast majority of M2, have been falling since last August. M2 simply shows us how much money is there in the system. There's a full explanation right here. But now, for the first time in a long time, the total money supply has been shrinking. As you can see, as we printed money each year, it increased, especially when the 2020 crisis happened, but now it is actually shrinking. Now we are seeing the consequences of the yield curve inversion that began last July, which I fear last September and described in the thread below. The inversion has worsened. Cathie Wood went as far as saying that the Fed risks plunging the US economy back into a 1930s-style Great Depression. And that was very scary, because in 1930s, S&P 500, the market, dropped more than 80% from the peak right here and to the bottom here. Many banks parked the stimulus gusher in long-term bonds at record low 1 to 2% interest rates, never expecting the Fed funds rate to surge a record-breaking 19-fold to 4.75% in less than 1 year. Now, deposit outflows are forcing them to sell safe securities at losses. Deposits are leaving banks to take advantage of higher yields in money market and other funds. At Silicon Valley Bank, startups were responding to a drought in venture capital funding by draining deposits to fund their operations. And this is where Cathie's warning comes in. Tonight, the FDIC, Federal Deposit Insurance Corporation, announced that all depositors, both insured and uninsured, at SVB and Signature Bank will be made whole, while equity and bond holders are wiped out. And pay attention to this. Why, I wonder, will equity and bond investors remain loyal to regional banks? And now the scary warning: if the Fed continues to focus on lagging indicators like a CPI and does not pivot in response to the deflationary forces telegraphed by the inverted yield curve, then this crisis will devour more regional banks and further centralize, if not nationalize, the US banking system. Cathie then says here how she is not surprised that Bitcoin skyrocketed as US regional bank stocks imploded. You can sort of time exactly when all of these bank runs were happening just by looking at what is Bitcoin doing. Crypto blockchains are decentralized, transparent, and auditable. Banks are not, and in the last few days have become less so. Regulators have focused investors on the threat that crypto poses to users, but this week can turn that theory upside down. As a single point of failure in the US banking system, SVB became the threat to stablecoins and the DeFi ecosystem. Then it broke Circle's USDC peg to the dollar. It was quite a show to watch this whole thing unfold, but now it's basically back to normal. The Fed always follows the fixed income market. The bond market is now demanding that the Fed ease dramatically. Here is the best breakdown of our current economy. Uber owns no cars. Airbnb has no real estate. And banks, they have no money. Our times are quite interesting. HSBC, the biggest bank in Europe, pays £1 to rescue the UK arm of Silicon Valley Bank. Look at how big HSBC is, and it just got even bigger. Michael Burry, who profited tremendously during the 2008 crash by shorting the market, is comparing 2023 to 2008 and 2000. However, he posted a new tweet, which now he deleted, just like he deletes all of his tweets very quickly. He said, "This crisis could resolve very quickly. I am not seeing true danger here." And I think he's talking about the fact that the regulators stepped in and seems like the massive crisis has been averted, but it could have been absolutely terrible. Still, I think it is wise to be on guard. This whole bank run was crazy. Here's what this venture capitalist Jason, who is also friends with Elon Musk, was saying. You should be absolutely terrified right now. That is the proper reaction to a bank run and contagion. I think this certainly contributed to having the government step in. The venture capitalists have been accused of causing this bank run. Let's see what they say now.
Well, I think last night's statement was quite good. I was actually very concerned yesterday morning after Elon went on the Sunday shows, and she sort of said some of the right sentiments, but it was very vague and unclear, and it didn't inspire confidence. And then last night, when they said that they were going to protect depositors at SVB, and they're going to create this new facility for all these regional banks that might have basically unrealized losses on bonds. I think that was a very strong step. So I think that, you can say that maybe it took them a day or two too long. I think Friday would have been better. The sooner you nip a banking crisis in the bud, the cheaper and easier it's going to be.
On Thursday, Silicon Valley Bank stock dropped 60%. And then on Friday in the morning, it failed to raise capital, and then it was very clear that the bank is about to fail. And once it was announced that the bank failed, that caused this domino effect and a big run on these other banks. So it would have been better if they maybe just said, okay, we're going to cover that bank sooner. They just said, okay, we're closing the bank, but we didn't really reassure what is going to happen. If that was done faster, maybe we could have avoided a run on some of these other banks as well. Hopefully the bank runs will stop now, but still I would move all of my money from a regional bank, if I had an account in one, to a bigger bank, unless the account is small enough for it to be fully insured by the government.
But I think they did get to a good answer last night. And I think now the question is it enough? And, it was still, I think, pretty disturbing this morning that you saw about half a dozen of these regional banks get clobbered, including fantastic companies like Schwab just get clobbered, and then they had to halt the trading of them. So that tells me that maybe it's not enough. And I'm sure you saw Bill Ackman had a proposal this morning where he just said, listen, we got to just come right out and say that all of these deposits and all these regional banks are protected. We can basically figure out the regulations and the FDIC later, but we need to basically go ahead and let depositors know their money is safe. I tend to agree with that.
I think that's what the government basically already decided to do. It is just that they are not saying it yet. That's what they are doing, really, but they are not saying it yet. I will probably talk more about that tomorrow.
Lots of fingers being pointed, including at you and your friends. I spoke to David Friedberg from the production board, one of your besties in the All In pod today, about the accusations out there that investors like you guys actually fed this problem early on by raising the alarm on social media and in private channels. Here's what he said.
Listening to people on Twitter from Silicon Valley telling them what to do, they saw what happened with this balance sheet, and they went out and they moved their money out of their smaller banks into big banks. That's it. That's what happened last week. And it was the beginning of what I think we're now seeing with First Republic today. And I can tell you, I got a list of other names that I've had friends say, this is what I'm doing, this is what I'm doing. And they're all going to B of A, JP Morgan, Citi, and Wells. And they're coming out of somewhere else. And where they're coming out of already has typically 10% margin of equity to assets. That's a very narrow margin for decline in asset values, particularly when you have to get liquid really fast to fund those withdrawals. So, it could very quickly get to be a cascading problem. And that's why I think there was so much vocalness last week.
Personally, I'm not blaming these venture capitalists. What I am blaming is the bank, the management of the bank that bet on interest rates staying where they were. They made a bet and they bought a lot of these long-term bonds, assuming that interest rates will not go up, and they locked in their money for a long time. That was very irresponsible.
Folks who blame VCs, investors, for sparking a run.
No, this is shooting the messenger. Listen, I didn't tweet about SVB or talk about it on my pod until SVB was already in receivership, and the runs had already begun on the next set of banks. The run had already begun on Signature. The run's already begun on a number of these banks that are now being shored up by the Fed. So the bank run had already started. I mean, we were just reacting to it. We were reporting what we were seeing. And we were disturbed by the fact that the regulatory authorities in the government hadn't spoken out yet. I mean, again, I tweeted on Friday afternoon, where's Yellen? Where's Powell? Why aren't they talking about it? I think we were drawing attention to a problem that needs to be solved immediately. And I think that was constructive. Maybe nobody was listening. Maybe their actions were taken regardless. But I don't see how you can blame us for drawing attention to a problem that, frankly, the government caused. This is a classic, I think, kind of CYA tactic where they try to blame the person who's noticing the problem instead of the people who are actually causing the problem.
I 100% agree with that statement. Absolutely.
I think the actions they took last night were welcome and definitely take the pressure off. So I don't think people need to be in a panic mode. I think in terms of best practices, these are not financial recommendations, but just some of the things that we discuss with our startups are that they need to have multiple relationships with financial institutions, that they need to think about their treasury differently than their working capital. It may be okay to have your working capital, which might be 1 or 2 months of payroll, at a startup bank or something they find more convenient. But our recommendation for treasury management is to have it at a top financial institution. And you'd have to say now that the SIBs are they are safer. And part of why I've been speaking out is I would like the United States to have a very strong, vibrant regional banking community. And the problem is that if the SIBs are basically too big to fail and the regional banks aren't protected, then everyone's going to move their money to the SIBs. I think Ackman's made this point. So I think part of what the Fed needs to be doing now is letting depositors know that these regional banks are totally safe. If they don't do that, then the incentive is going to be for depositors to move their money to, 4 of these systemically important banks. That'd be a real shame in my view.
I agree with David here. By default, the big banks that are systemically important, the SIBs, they cannot fail because they would be bailed out by the government anyway. But regional banks, because they are so small, if they fail, then not really a big deal. But if all of them fail, which now, if you don't protect these small banks, they will evaporate. And that is a bigger systemic risk than having just one big systemic bank fail, because all of the regional banks, I think, when all put together, are more systemically important than a lot of these systemically important banks. Hopefully no more bank runs, and hopefully we can all move on. In the meantime, I am keeping my Tesla stock, and this is the Tesla stock buying opportunity explained by Elon Musk. My name is Matt Posius. Like and subscribe if you haven't yet, and I will see you in the next video. Thank you so much for watching.